So everybody loves to say that the Bay Area is way too expensive, or that it's really too far out of reach when it comes to buying real estate, or that prices couldn't possibly go any higher. But history and the data would show you otherwise. And we've seen this movie before with the 90s .com era causing a huge run up in prices, and we're seeing it all over again with the AI revolution that's happening right now here in San Francisco. And the reality of all this, the Bay Area isn't crashing or correcting anytime soon. If anything, it's just consolidating for its next big run. Now, this isn't hype. There is rationale behind this. There is data, there is economics, there are forces when it comes to technology, innovation, that are driving what I'm saying now. And I'm a gambling guy. I'm originally from the state of Nevada. So I will tell you, in putting my money where my mouth is, I would be betting big on a continued Bay Area run, specifically here in San Francisco, as opposed to taking the opposite bet, which a lot of people here on YouTube, prognosticators, people that put out a lot of doom porn and say that the market's gonna be crashing or it will crash sometime here soon. Some of these people have been saying this since pre-COVID, and look what happened. Now, there's always the rare one-off black swan occurrence that can happen, but given the data and the economics that I'm gonna share with you right now, you too are probably gonna put your money where my mouth is. The area in which I wanna start is why Bay Area prices are still so high. But before I do that, let me quickly reintroduce myself. My name is Arjun Dhingra. I am a 24-year veteran of the mortgage industry. I've been here in the Bay Area for much of my career, assisting families and individuals with doing real estate investing or just buying a home for themselves to be able to live in and change the trajectory of their financial future. We help people make smarter decisions when it comes to taking out mortgage debt, because it's so much more than just a mortgage. It's a tool and an instrument for creating wealth. And if me and my team can be of help to you in any way, shape, or form on this topic, please reach out to me on Instagram at Arjun Mortgage. Drop us a line and let us know how we can help you put together a strategy and a blueprint for changing your financial future. I believe in this market, I own in this market, I live in this market, and I want to be able to instill that kind of confidence in you too. So we'd love the opportunity to help. And with that, let's get into today's topic. Okay, so why are Bay Area prices still so high? First is the reality check when it comes to supply and demand. Basic economics 101. Inventory is historically tight. Often 2 months of supply or less are what we see in the marketplace. And because of regulatory hurdles, legal challenges, zoning restrictions, and high construction costs, building new homes, where it might be an option in other markets, just isn't possible in the same way here in the Bay Area. In fact, it's next to impossible to do here. And even during slow years, demand outpaces supply because of job and income levels. The second reason why prices remain high here is the wealth factor. The median household income in San Francisco, Marin, and the Silicon Valley markets far exceeds national averages. Buyers here are also asset-based and not rate-sensitive, with many of them not actually earning their income by way of a W-2. This area is very dense with self-employed or entrepreneurs. And a $2 million home is not a stretch buy when your RSUs or your AI equity just suddenly doubled overnight because of a new headline that came out. And that is exactly how fast the market here is changing. Literally, one piece of news can change an employee or a company's financial picture and standing to the upside and actually leave them there. And again, guys, this is not a comparison to other markets, because San Francisco is its own unique animal. The Bay Area, for that matter, is, when we include Silicon Valley, Marin, and San Francisco itself. And the third reason why prices remain high here is the global demand factor. San Francisco is still an international hub for talent and capital. People don't move here for the affordability, or lack thereof, let's say, but they move here for the opportunity. The best ideas, conversations, collaborations amongst entrepreneurs are happening right here in the Bay Area. People recognize this from across the globe, and that is why they flock to this very market. Okay, so there's your three-part answer as to why prices have been so high. Now, let's get into why they are going to stay high. First is the supply lock-in effect. Some 90% of Californians that own a home are locked into a mortgage that is less than 4%. And considering that prices haven't actually come down, the trade-off for them to abandon that cheap mortgage for a more expensive home at a higher interest rate doesn't make a lot of sense. So they aren't selling. And we need sellers to create inventory before they go out and absorb what little inventory there is out there for them to choose from. But without selling anything, this makes it even tighter. So we are in what is considered a chronically undersupplied market. And that is the #1 driver of price resilience. When you have way too tight supply, prices continue to have upward pressure. And that brings us to now the rate effect. Every time mortgage rates drop 1%, it adds anywhere between 4.5 to 5 million buyers nationally to the pool. Now, relatively speaking, when you look at that number here for the Bay Area, that's a lot more buyers that are entering in. And what happens when you have more buyers? You get more bidding wars, you get more competition, you get more people willing to throw whatever they have to throw at a property because, again, there's such little supply. And if they really want that home, they're willing to pay a few $100,000 over the asking price just to put this process to bed. It sounds crazy, but it happened a lot during the pandemic and it still happens today, even in this tight market. Now, speaking of mortgage rates, we're already seeing the impact because mortgage rates have been dipping. And in fact, they're at about a 1-year low presently. But with adjustable rate mortgages now becoming more appealing and attractive, we're seeing rates already in that 5% range. So this flood of new buyers have already been coming back into the market because psychologically, that was the number needed to kind of tip the scales and get more buyers back in. It's not necessarily what the market needs, but it's what's actually happening. So when you have a lot more buyers and you have zero change in inventory or just zero inventory in general for certain markets, you get upward pressure on prices. And the last reason why prices will remain high is because of real estate being the safe haven that it is. Wealthy investors and people with lots of capital see real estate as an alternative asset class. And when stock markets, for example, get a little bit frothy, they like to put their money into something that's a little bit more predictable and secure and something that they can touch and feel all the time, which might be their own house. It is a great hedge against inflation, volatility, and currency risk. So tangible assets in the Bay Area, like houses, get bought up all the time whenever all these other markets start to feel like they're getting a little too hot. Now into part 3. And this is why I'm betting so big on San Francisco and why you probably should too. And that is the AI boom. Now, this is a deja vu or a circa .com exposure from the 90s. You see, in the 90s, the .com boom created a lot of localized wealth. Housing demand exploded and prices doubled in less than a decade across the board here in the Bay Area. Roughly 70% of all those startups failed, but the 30% that survived and came after, such as Google, Apple, Salesforce, ended up changing the world. And not only changed the world, created so much of an economic boom within their own industries with all the hiring they did and all the capital that they have raised and created and reinvested, that the local market ended up being one of the immediate beneficiaries of it. This redefining permanently of the actual economy here and its impact on housing ended up resulting in 20 plus years of appreciation. So now let's look at the AI gold rush. You have 350 companies with physical presence here in the San Francisco, Silicon Valley area. Not all of them are going to last. We can probably use some of the same numbers from the .com era. So let's just assume that 70% of them fail, which will probably happen. It's just part of the cycle. Not everybody can win, but the 30% that do stick around are ultimately going to change the world. In fact, it's already happening. Just look at OpenAI as one example. It's changing how everyone's doing anything. And what was once thought of as a monopoly that Google would have forever on search is actually at risk because of what OpenAI is doing. There's massive VC and corporate investment going on right now in this space. Billions of dollars are flowing into payrolls, office leases, and other financial ecosystems. High-earning tech employees are coming back into the city, and they are paying that high rent that continues to climb and put more upward pressure and absorbing the housing stock that's here, even though it's quite limited. So this is creating a lot of pressure points in San Francisco, the Peninsula, Marin County, and of course, Silicon Valley. So here's what this AI boom means for real estate. First, expect sustained demand for both purchase and rental markets. The Bay Area's brain economy also makes it nearly recession-proof in housing demand terms. And lastly, just like the 90s, this surge will mint new wealth and compress available housing stock even further. Okay, so now that you have all this information and understand why prices got so high, why they will remain high, and ultimately why this AI boom is having such an impact, what should you as a buyer do? First is, do not wait for perfect timing because it doesn't exist. Waiting for prices to fall in the Bay Area, and I mean formally correct. Yes, there might be some slight pullbacks in certain segments or neighborhoods and enclave, but to wait for it to somehow fully reverse course or even crash is like waiting for Bitcoin to get to 5K again. It's just not gonna happen. At the end of the day, we have to remember that the entry point is not the problem. Your time in the market is. The next important thing that every buyer should be doing is to buy strategically and not emotionally. Focus on flexible financing. Take advantage of the fact that adjustable rate mortgages have made a big comeback. They're very safe and well structured, and you have to qualify for them. So it's not like they're just handing them out to anyone. But these are a great way to take advantage of even lower interest rates and increasing your affordability. Alternative income programs and rate buy downs are also still very popular and a great way for you to gain access. Another great strategic play is to identify sub-markets with upside. Marin, Daly City, South San Francisco, San Leandro, parts of the peninsula even, which have been dismissed by many real estate experts in months past, but are ultimately going to be the beneficiary of other markets getting too crowded or too hot, and people will spill into them for a little bit better affordability, but that will be your opportunity and chance to take advantage of that upside and influx of demand. And the other thing with your strategy, guys, is you have to partner with A-level players. A-level mortgage advisors and A-level real estate advisors. People that can create multiple pathways for success here, whether it's through owner occupancy or buying for investment purposes. Amateur hour is over, and I've said this in many videos and a lot of the content that we put out online. You have to be working with pros, people that are well connected to the market, have a pulse on what's going on, even access to things that are off market and that the rest of the general public does not know about. So don't mess around here simply because your friend has a cousin who's licensed and could really use the commission in the business, because the stakes are too high and the market is just too competitive. And lastly, guys, when it comes to what you should do, the timing is important. And if you can't buy right now, after doing all your analysis and running through this gamut, then start to prepare for buying in the future. Maybe you need to build your capital base better, whether it's through saving more money, acquiring some gift funds, having conversations with family, making other investments where there's some significant short-term upside, such as crypto, even side hustles. All of these ways, all of these can help you increase your available down payment, which is going to be what is needed to make such an investment and gain access to the market. The next thing is when you're working with an A-level lender or a true mortgage advisor, we get people prepared and fully underwritten so that they have what I like to call the loaded gun. If everything is done and the gun is loaded, if they see a property, they can actually shoot their shot and act on it, because speed kills in this market. And I mean kills in a good way. Not killing your deal, but actually killing it for you and making sure that you actually win. Nobody likes strings attached to any deal. So you want to be clean, you want to be fully underwritten, and you want to have that loaded gun so that you can act quickly and jump on the right place. And lastly, guys, just follow the market and not the noise. If you're working with good people, they're gonna help guide you with this, but if you're absorbing information and content online, be selective about where you're getting it from. Make sure that it's from real pros and not people that are focusing all of their content and their voice on hype, but that it is data and economic driven and there's real substance behind it. Kind of like this video. All right, guys, so the Bay Area has always been the epicenter of innovation, and innovation ultimately creates wealth. Whether it was semiconductors, the dot-com era, or now the AI boom, one thing has not changed during all of those iterations. People who own real estate always win long-term here. So drop us a comment here if you think we are in another tech-fueled housing boom, or if you completely disagree with this video and its premise and the data that I've provided you with and think that the market is going to crash, also drop us a comment here, because I'd love to hear from you and understand where you're coming from. And again, if we can help you, make sure you reach out to me via Instagram at Arjun Mortgage, and we can put together a plan, whether it's for right now or somewhere into the future, that you can get your piece of this run up in the market. Thanks again for watching, guys. Reach out if we can help you in any way, shape, or form, and we'll see you guys on the next video.